So thanks everybody for joining us today. And as I was sharing with the panelists today, I was actually quite greedy this time around. I caught a lot of people because I thought that, it's quite rare to have a successful fundraising for this period. And since I know the 3 cases here, and I have 2 very active investors during this period who are very happy to share, I thought just grab you guys and everybody come and share. So we actually have 150 plus people registered for the event today. But right now online, I think people are just slowly strolling in. So for those people who are not able to come on the Zoom webinar, please use the Facebook chat, and we will monitor the Facebook chat for the questions as well. You can put up a question there, we'll try to address them. So Serena will help me monitor that part, okay? Yeah, so before, let's just have a very quick introduction from the panelists today. Because we have a big group, and I was telling the group that we want to be very strict about the timing. We want to keep the last 20 to 25 minutes for the floor to ask questions. So please actively put out your questions on the Q&A board, the box at the bottom. We will not be monitoring the chat because the chat flows up and it's going to be very difficult for us to track. So before we start the chat today, can we have the floor share a quick self-introduction? We keep at 2 minutes each. Maybe we have ladies first. Maybe Peg In can share first.
Sure. Thanks, Shawnee and team for having me here. So I'm Peg In, co-founder and CEO of PS Love Private Limited. So PS Love, we provide game-changing period care for women. So we've launched a range of period pain products that helps females across the world. And our just very brief about the company, so you all can have context on what we're about to share, is that our key channels to reach consumers are via the offline as well as the online space. So obviously, COVID has impacted in a very great way, which I can share more later. But maybe a little bit more about myself is that I used to also work in NUS Enterprise, so I'm quite familiar with the startup scene, and yeah, happy to share anything in a very candid manner during this session. Yeah, thank you.
Oh, that's very fast. That's less than 50 seconds. That's good.
That's small time.
Yeah. So maybe we can have Caleb share next, the co-founder.
Sure. Hi, everyone. Nice to meet all of you. So Peg already introduced the company, so mine will be even shorter, right? So I'm heading up the commercial side and business development at PS Love. So really both within Singapore as well as the South and Southeast Asia region. So for me, the main focus is working with key channel partners and retailers to bring our products to the mass consumer market. So that's kind of the main focus that I have. Then my second so-called hat that I wear is managing the product development within the company. So where digital as well as the physical product innovation happen, as well as working together with the engineers, designers. So that's the second main thing that I do. So a bit about my background. I like both hardware and software, although I'm not like a super expert at both. Managed to assemble my first computer at 12. Then I did dive into some hardware conveyor systems, inventory management software while I was studying at NUS. So I studied real estate finance, which has absolutely, I'm not sure what it has to do with consumer products. If you know, please let me know. And I was also from NOC Singapore, and I have about 5 to 8 years of doing like sales and business development. Yeah, thanks.
Okay, thank you. Thanks, Caleb. Could we have Dustin? Oh, just nice for the 90 second. You heard that, right? Okay, can we have Dustin next?
Yeah, sure. Hi, everybody. My name is Dustin, and I'm the co-founder and CEO of Yuhu. And what we do at Yuhu is we're the most advanced and most comprehensive indoor air quality monitoring and management system to help you enhance your health and well-being, both in the home and in the workplace. So our market caters to the B2C market, B2B markets, and we also have clients in government. And due to the COVID-19 situation, awareness on air quality and health just skyrocketed like crazy. And as part of that, one of our innovations that we launched just last month is the Yuhu Virus Index, which is we are able to assess in real time the survival risk and transmission risk of COVID-19 using air quality data. So that's a world first, and we patented it in Singapore. And yeah, and we're present in roughly 40 countries through our channel partners, and we have our local offices in Singapore, Hong Kong, and the Netherlands. Yeah, that's a brief introduction about what we do.
Okay, thank you very much. And could we have the last but not the least founder on the panel, Nimanta, please?
Sure. Thanks, Shawnee. So thanks for having me, first of all. So hi, everyone. I'm Nimanta, co-founder and CEO of Axio. If you're wondering about the name, it's actually origins from Harry Potter, a spell called Axio, which brings far away things from you to your hands. And that's what we do at Axio. There's a lot of industrial data in construction sites and mines, a lot of sensors that are scattered around. And with our magical technology, we bring all of that to your fingertips for real-time decision making. So the company was founded by myself and my partner Mubasha. The two of us did our PhDs in wireless networks and wanted to put that knowledge into industrial use. And that's when we started the company in 2016. So since then, we've come a long way. Our products are being used in about 15 countries now to monitor key infrastructure development projects and mining projects in several countries. So I guess I'm here because we just recently raised an oversubscribed pre-series A round with all this COVID stuff going on. It was a very interesting experience. That was our third round that we raised, and by far the most challenging. So I'm here to share some of our experiences.
Okay, yeah, thank you. Thanks, Nimanta. And I'm glad to hear your closing of the round too, because you started during COVID, right?
Definitely.
Yeah. Okay. Next, we would like to hear from Wishen and Michael, the two investors who have bravely invested during this period of time. Who wants to go first?
I have my mic on. Maybe I'll go first.
Okay, thanks.
First of all, congratulations to Nimanta as well as the other founders on the closing. I think, like you said, it's not easy, right? So great job there. So for me, I'm an investment manager at Qualgrow. So Qualgrow, as some of you may know, is a B2B focused venture capital company based in Singapore. Our sweet spot is usually in the Series A and B stages, although we do some pre-A companies, pre-A stage investments. In terms of geography, I personally cover more of Indonesia as well as Singapore, but we are really quite Southeast Asia focused. One of our partners sits in Australia as well, so we have some Australian investments too. I guess that's a little bit about the VC fund. We are operating out of our second fund now, actively investing during this period. I don't think we have. I mean, on our side at least, we've seen some slowdown in deal flow, but you know, still quite a healthy number of deals that we are seeing each week. A little bit about myself, my background. I started in consulting, very traditional kind of corporate background, and then from there I did my MBA, and when I did a stint in China with Alibaba Group, and then I was part of the founding member of a team that was part of education tech startup based in Singapore.
Okay, thank you, Wishen. Well, just nice. Could we have Michael, please?
Thanks again for having me, and congratulations to everybody who closed their funding. A bit about, I'm managing partner and co-founder of Cocoon Capital, which is an early stage seed fund based out of Singapore that covers Southeast Asia. We invest across the region. We've got companies from Myanmar to the Philippines and everything in between. We do pre-seed and seed deals, so we invest anything up to $1 million. We're active investors, so we do a few deals a year, but then support the companies a lot post-investment. Our focus is on deep tech and enterprise tech. I've been an early stage investor for the last 20 years, and before that, I was an entrepreneur. And I can honestly say I've never actually done so many deals as I have in the last 3 months. I've actually closed 5 deals, and I'm actually doing the first deal, closing the first deal where we've never actually met the founding team in person, which has been really hard for me, got to admit. But yeah, and that's very much about me and about Cocoon.
Okay, thank you so much. Thanks, everybody. So we will go into the, not so much an interrogation, but just get everybody to share your journey. And as quite a few of our members actually have commented that AngelCentral is quite candid. So I'm going to pick in up on the candid part, right? We want to share openly with both our members, investors, and also the startups who are here. I think we have almost about 60-40 ratio based on the registration of profiles, 60% being founders. So I want to address the elephant in the room first. In this whole process in post-COVID, did the valuation come down? Did the expectation, was the expectation still high, but the final offered and transacted valuation, how far, or did it change, did it come down, and how far is the distance?
If I can answer from the deals that I've done, valuation hasn't, it's impossible to value a seed deal. There's normally no data. So we've always targeted to get around 20% for 18-month runway. And sometimes it's been a bit below, sometimes it's a bit above that. But it's normally, I would say, between an 18 and 22% range. And that's how we pretty much done. I said, what's the last few deals we've done? It's been more around the 23, 24%. But that's because we've been asking the companies to raise for 24 months rather than 18 months. So they've given a little bit more money away, but we've invested slightly more for longer runway, just because of the uncertainty of the market going forward. So we just thought having a little bit of extra money, but the pre-money valuation for us hasn't changed.
But how about the actual cash projection that they think that they need? But because you changed from 18 to 24 months.
We've changed from 18 to 24 months, which is why we've taken a slightly larger chunk, a few percent more than we would have done in prior, just because they've asked for more money, because we want them to have a longer runway. And our assumption is the revenue is not going to come as quickly as we would like, because we wanted to overfund at this stage where normally we wouldn't have been so aggressive on it, just because of the uncertainty that COVID-19 is bringing in terms of sales.
But is the percentage that you're taking still the same? Because that would affect
the percentage, yeah. The percentage has gone up a few percent, but otherwise it's roughly the same.
In a sense, it has come down, right? I mean, mathematically speaking.
No, because the pre-money has stayed the same. It's just that the amount they're raising has increased, which means that they're having to give away a few percent more.
A few percent more, yeah.
Yeah, but the pre-money hasn't really changed.
Okay. Question on your side? Key change?
So I guess Quagga we invest a little bit after Michael, after Cocoon Capital. So and from a seed perspective, I completely understand. I think there's no way to value anyway, so it shouldn't matter. It's more about the dilution that you want to accept, right? For me, I think on average, I have seen valuations come down indeed. But I have also seen some other startups. So I guess it has been kind of like the great equalizer. There are some companies that, even before COVID, we knew that the valuation was quite frothy. So those companies have come down. But there are other startups that have not been as affected because of, strong fundamentals and things like that. So even with COVID, they still hold up strong. So those have not been quite affected. In terms of numbers, I guess one of the more drastic ones I've seen companies, they were asking before COVID at around 100 million, coming down to 60, and even at 60, still it is not hotly subscribed yet. And because I see most of my deals come from Indonesia and Singapore, so I'm averaging it out, right? I think, in any case, I think valuation at this early stage, right, is just one thing to look out for during fundraising. The other thing, which I think Michael has pointed out, is also cash flow requirements. As the uncertainty prolongs, we don't know how much cash is required, and we don't know what the market will look like, even 10 months down the road. So I think the general advice is to raise a bit more. I think it's slightly easier for B2B companies, but not always. But you can kind of more easily project what B2B companies need, because you kind of know okay, these are the expenses that is required. There is, how to say, it is not as variable, I would say, in terms of expenses as consumer-led companies. So for us, I think we still got quite a good sight of what valuation ranges could look like. But in general, yes, answer is yes. I think it has come down.
Okay.
But just following on that point, though, a couple of our follow-on rounds that have happened, there's always hot sectors. And in the hot sectors, the valuation, so the hot sectors have changed kind of from where they were in December of last year to where they are now. So our companies that are in like telehealth or logistics or ed tech, their valuations have shot up because all of a sudden it's become a hot, and VCs, we're kind of like FOMO, we kind of like follow the trends. We're being realistic, I shouldn't admit that. You can shoot me later. And then other sectors that were hot have, you know, like there was a lot of stuff going on in travel, there was a lot of stuff going on in ride hailing and all these other spaces. They've become very unpopular, so their valuations have come down. So it's literally, you know, it does depend on where your sectors are, and what's seen as hot by VCs does also have a massive impact on valuations.
Okay. So I want to change the focus a little bit to the founders right now. So I think PS Love started before the COVID period, right? But it kind of like overlapped during the period. Dustin also, Yuhu also started before that. Nimanta started at the time when COVID was, you know, we were all getting worried about whether we need to get our masks. So can you share your journey along the way, how you were feeling? And I mean, you were raising actually your second and even third round for some of you. So the thinking very much was, you know, you had projections, but now the projection seems like, you know, something is not quite the same. How do you manage the whole process, and what was your learning along the way that you think you really had to change? You literally had to pivot your thinking.
Yeah, definitely. So I'll start from January. That is like when we were planning our fundraising stuff, the capital raise for this year. And in January, we actually had some high-level terms for a venture debt offer, because our idea was like we had some equity capital in the bank, but we are hardware, like a big portion of our software is hardware focused. So like there's a lot of manufacturing that is involved, which we have to pay upfront, like to our contract manufacturer, for which we need capital. So our investors and our board and our advisors advised us that we should have a venture debt facility that could be used for the manufacturing costs, and use the equity capital just to finance our day-to-day running expenses, salaries, and stuff like that. So along those lines, our plan was to have a venture debt offer and use that capital for our manufacturing expenses, as I said, and then go for a Series A round towards the latter part of this year. So this is the plan that we started the year with. And in January, we had a really attractive facility, high-level terms for our venture debt arrangement. And then this was January, and then things were discussed, negotiated, and we had like kind of like almost finalized everything. But before we could get to an official term sheet and sign, COVID struck. I mean, COVID was there, but it got worse. And then the institution that we were speaking with, like they switched into more of a portfolio management option to ensure that their existing portfolio don't die, and they sort of like heavily clamped down. This was February. They completely clamped down on their like new investment side of things, because like the beginning of like when COVID was going to get worse. So they really wanted to wait it out and see how things would go, and whether we would be able to get through COVID, and all those uncertainties came into the picture. So we really had to pivot at that point. And in February, we, like I still remember the board meeting, we had a quick call, figure out what to do. And we thought, okay, let's do a bridge round and get the capital that we need to keep the business going, and go for our plan Series A, like maybe early next year. So that's how we pivoted, and we ended up doing a pre-Series A round. Valuation-wise, I think we got a fair one based on where we were. So no complaints there. And like but the key difficulty that we had was getting new investors to join. So if we did have some new investments coming, but majority of the round was raised with our existing investors. So all of them helped out, and we managed to close the round mostly with those like the existing parties. We reached out to a quite a number of new investors to see whether we could get them on board, like early stage investors. But yeah, we didn't get any positive responses because a lot of them were managing their existing portfolio, or like were having cold feet about like getting into new deals. And yeah, so our success came through like the relationships that we have built with our existing investors, and our business was doing well. Like organically, we were growing. We grew our Q2 revenue by 5 times when compared to Q1 revenue, despite all this stuff that was happening. Because we are focusing on an industry where like still construction, right? So it's going on in a lot of countries. So business kept ticking, but yeah, that helped to give confidence to the existing investors mostly.
Okay, that's a very insightful point, because it's what you have done with your existing investors along the way, right? Because if basically ignore them, they are not going to take your calls when you need help too.
Exactly.
But is it the same experience for PS Love and Yoo-hoo?
Yep. Maybe I can take that one. I think similar to what Nimanta faced, we also did raise a slightly smaller round. I mean, in terms of the process, we started slightly before started preparing slightly before Chinese New Year. So a bit of context, we did close our Series Pre-A about 2 months ago in May. So it's the usual preparation. You get a long list, find fit for geography, stage, check size, focus areas, and then asking for warm referrals, and then just keep following up. So when the pandemic struck, definitely we had to adjust the projections, especially like the nearest 2 to 3 or even 4 quarters. There was an excellent AngelCentral event with ShopBack and PetSnap. So definitely learned a lot from that event. About streamlining, cutting expenses. I mean, obviously, quite a number of investors had to walk away because of various reasons. Could be capital conservation, etc. So for us, I think how we approached it was, reach out to more of them, evaluate other options such as raising later or raising a smaller round, which we eventually did. And also, reducing the immediate burn, which anyway should go down because near-term growth spending would also be reduced because of the pandemic. Yeah. And the last thing would be we did diversify. So we did a mix of both debt as well as equity. Yeah.
Also, you changed the strategy of how you raised.
We were initially looking at a mix of debt and equity, but I think given the low interest rates, we decided to do more from the debt side and then more from the debt side. Yeah.
Yeah, that's extremely smart. So one of my other startup did the same. So he was actually planning to raise, getting ready to raise by 2021 early, but because of the low interest environment, and he has a benefit of having good flow of POs, so he's able to get the buy-ins from the banks for some cash flow support. And Dustin, any to share?
Yep. Yeah. Our story would be pretty much similar as well with what Caleb and Nimanta mentioned. So we started our fundraise for our Series A right after Chinese New Year. So that was early February. And that's when we started reaching out to investors, feeling the market and all that. And suddenly COVID struck in March. And what we did was, okay, this is going to be much more difficult. So we decided to raise a bridge instead of going for our Series A. And that's when we spoke with our existing investors, Wavemaker and a few other angels. And they were the ones who led this bridge round. So the moment they put out the term sheet, we were able to get it completed within 3 to 4 weeks. And we were 50% oversubscribed. So that was a good thing. And what happened to the business was, instead of just focusing just on fundraise, we actually focused a lot on the customer. So we didn't really pivot, but we made our solution and our product much more relevant to the COVID-19 situation. Thus the launch of the Yoo-hoo Virus Index, which we did in June. And that really helped push the demand for our product much more. So since we started this year up to June, we were expecting a slight decline in revenues, but in fact, we are 20-25% above plan. So we're still growing even on a monthly basis. Yeah. So far the COVID-19 situation kind of benefited us in a way. Yeah.
That's good to hear. Yeah. Okay, so we are around the 4:30 mark now, and I think I actually see a question on Facebook right now. But I was actually just going to ask one more questions that because Michael kind of like led to it, right? The whole due diligence process was virtual, was online. How did that feel? I mean, from the investor's point of view, how did that feel? Because the thing is, you got the right checks out based on this person that you basically see on the computer screen, and then you know, your spider sense probably don't work. Like for me, a lot of times it's really how I feel gauging on a person. And then one person I experienced, actually one company that we were very interested to invest in, but I just couldn't commit. And then when phase 2 opened, I told Dashing, let's call the guy out for breakfast. Then it's only after breakfast that I could settle myself. So how was it for you guys that, you know, Michael, you're saying that something that was throughout, and then Wei Shen, maybe, so it's probably not so rare for you because previously you could fly, but I think a lot of conversation was still through virtual. Yeah.
I think for me, in terms of the due diligence in the early stage, it's all about the people. There's not, very rarely is there the product or anything. So we, you know, there's not many customers we can normally go and talk to. There's not much data that we can review. So it is very much about the people side. So all the deals that we've closed so far, we had a chance to at least meet the founders once in person. So we did have that. So we're going through a process now where we've never actually met the founders. And I struggle the same as you. So we have just a lot more meetings, and probably the deal is going a lot slower than it would previously because there's that uncertainty. Because I feel very much the same as you. Unless I meet the person in person, then it's very hard for me to take the leap. So we have to do more checks and balances. And we also do a lot more. We've started using tools like Fingerprint for Success. So which we find actually have been, so we've actually found really, really useful. Doing some like motivation testing and everything. We've actually done it. We've kind of backdated it on our whole portfolio, and actually it's come out being very accurate in terms of supporting some of our decisions and, you know, showing where we made right and wrong decisions. So probably what we do now is we have a lot more calls with founders than we would have before, sometimes just for a general chit chat. So it's like literally like have drinks over Zoom, just because a lot of it is not just getting to know them as business people, but getting to know people, the founders on a personal level. So we've tried to do it that way. So I would say what's happened is things have got slower. All the due diligence stuff outside was mostly done remotely anyway. I think the only thing that we've not been able to resolve is I've always liked to go to the offices of the companies to actually talk to employees and talk to see what the environment is like that they're working in. Obviously that's we've not been able to do, but you know, like we always tell entrepreneurs, they've got to adapt. Us investors have to adapt as well. We're just going to have to live with it. But I think for me on that side is as I said, we're still being actively investing, probably faster than I've ever done before. So it's obviously not stopped me on that side.
Okay. Wei Shen, any sharing of your trepidation?
Sure. So since COVID started, we made three investments, and I'm in the midst of looking at 10-ish or so right now. Quite deeply in a more than just preliminary stage. Of the three, one was actually done more or less the terms were settled before the lockdown. So that one I don't really consider that part of the COVID investments. The other two, we actually only met the founder once last year, just one time at an event, and that was it. And then the remaining diligence was all done online. Interestingly, these two deals were slightly earlier stage than what we would normally do. So pre-A, both are kind of like in the pre-A stages. And I think because it's pre-A, therefore the check sizes were smaller. I think we were a little bit more comfortable to write those checks, even though we didn't have the chance to do as deep diligence as we would like. But that's not to say that we would not, consider writing checks for larger companies, because I think right now we can do some meetings now, right? So I think it's okay for now. the one thing that I think that one of my behavior that changed was that I did a lot more reference calls than I would have normally did. In the past, we always do reference checks, right? And it's part of the process. And you don't do as many because you meet the founder like 10 times before you invest. And during those 10 times, you kind of get a sense of who he is, where is that. You problem solve some questions together. You negotiate. You get a sense of who he or she is. On video, it's harder to do that. And therefore, those reference calls really make a difference. Especially if those reference calls are, by parties they did not know that they're going to receive a reference call, for example, or it was not recommended by the founder, right? They will give pretty candid feedback, and of course, all these things you have to calibrate and take it a little bit at face value because some different people experience different things. But after you make like 15 different calls, you kind of you converge on a point. Some of the commonalities, common traits come up, and then you make a decision based on that. So definitely, I think actually now that I think about it, post-COVID, that's probably a behavior I would continue to do as well because I thought it was really useful.
Yeah, totally agree. So from the founders, is there any? I'm not going to go through everyone, but if you have something to share, like how do you prepare for the virtual due diligence? What do you do differently that you didn't expect yourself to do, but you actually had to do it? Like I know that we did a virtual office visit, right? And Kate was walking around with the laptop to show us the rest of the office and the storeroom.
Yeah, maybe
and
I'll
Dustin did this way. Yeah.
Yeah. So I think the challenge is really in building trust. How do we convey that trust through a virtual meeting per se? So I think the office tour kind of helped in that, because apart from just knowing the founders, I think that knowing the environment and the kind of workspace that we are working in kind of help form a certain impression of how the startup is looking at things or growing the business. So I think as founders, maybe some tips that we can give to the other founders is, think of creative ways that you can really build that trust, even though it's just a virtual. Whether is it sharing, getting some of your team members online to just share the experiences, or even showing the tour of the company. I think all those could help. And I think for us, it was a very interesting experience as well, because we didn't have that before. Yeah, typically physical meetings, we just meet the investors and we have a chat. But I think that whole experience was really interesting. Yeah.
Okay. Yoo-Hoo and Nimanta, any Michael drop off. Oh, Michael's back.
From my side, nothing changed, Xiaoning. Because as I said, most of the investors existing ones. So for the new ones that joined, they were happy to get access to our data room and like all the usual due diligence stuff on the financials, the product. And so we went through quite a number of calls and did deep dives into the technology, and the other calls did like deep dives into the business models, and then gave access to the data room, which we typically do with all our potential investors. And that was about it. I think the process-wise, it was pretty much the same for us. Nothing really changed.
Okay, thank you. Dustin, anything to add?
Same case for us. Nothing much change. It's just that no face-to-face. Virtual is fine. We're all tech companies anyway. Yeah.
Okay, I'm going to, we have actually 3 questions now pending, or quite a few. So I'm just going to go down the list, okay? Oscar asked a question. He said that, how has COVID impacted the speed at which the VCs make their decisions and how long it takes to close a round? So I think, right, actually just now it was hinted, you do a lot more work behind the scene. So I guess, but how much longer? And either way, Sean. Yeah.
I would just say, because we do so few deals, I think we made the decision relatively quickly. We're very much like, you've got to go on gut when you're doing kind of early stage deal. In terms of the due diligence, probably an extra kind of few weeks. So we try and close on the normal time. We try and close deals from meeting the company to closing within 2 months. I would say it might be like 2.5 months now. but the intensity of the amount of interaction that we do is very fast. So of the 5 deals that we've closed so far, one of them we had met kind of the end of last year, and it's, you know, we closed quite quickly. All the others, we had 2 of them we had met the day before lockdown started, and we managed to close it within kind of just over, both of them within like 2 months. So it was very much focused on that one. So again, extending the runway for the founders is actually going to, we find, causes issues for the companies. So it literally for us, we don't try and extend the runway. It's just the amount of meetings and calls that we have with them is probably a lot more than we would have done in the past, because we would have been able to sit down with them over a whole afternoon. What we found with like Zoom calls, doing a 4 or 5 hour like Zoom meeting is not really productive for anybody.
Yeah.
So we've broken that up as well. But speed-wise, no, it damages the companies because they're too distracted if it goes on for too long.
We should.
So the question is around speed of the fundraising close, right?
How long does it take? Yeah.
Yeah. I don't think I've seen a significant change. I mean, ultimately, the speed of fundraising close is kind of correlated, or strongly correlated with supply and demand, like how hot that particular startup is versus how many investors are chasing it. And I guess for some companies that we've seen, which are, you know, they had good fundamentals before COVID, during COVID, it doesn't change those fundamentals. And during COVID, I think some of these companies, they wanted to extend their cash buffer a little bit. Yes, they have been affected. They have been affected by COVID, but I guess investors know that these guys have strong fundamentals, so they are still quite sought after, and so they were able to close quickly. So I don't think I've seen COVID impact speed of fundraising close that much.
Okay.
One thing I have seen change is, of all the deals that and I obviously think they're all good deals, but normally when we give a term sheet, there's normally 1 or 2 other term sheets at least that the companies are receiving. For all the companies, we were the only people that they were even willing to take meetings with some of them, let alone having competing term sheets. So there definitely has been, the VC community over in the early stage, for the last few months, has definitely been more inactive than they have in the past. For some of and if you look at a lot of the seed funds, they have much bigger portfolios. So I think a lot of it is because their focus has been more on supporting their portfolio than it has been on doing new deals. And I think, I don't know, but I'm assuming things are going to begin to pick up now because they've stabilized a lot of the companies within their portfolio. So the length hasn't increased, but I think the amount of VCs who are actively being invested in the last few months have definitely decreased for a period of time.
I think I agree with that. I don't know whether Techmo you see the same also, right? Because on our side, we can see that a lot of our early stage, a lot of angels and early stage funds are a lot more cautious.
Yeah, I would think so. I think mainly because there's sufficient uncertainty in the environment.
Yeah.
So when you think about the success of the startup and the founders, the journey, we need to think about how are they coming out and how do they adapt with the current situations, and how do they think about their runway, and especially what the KPIs are. Because you must remember, for startup founders, if you cannot raise a second round when your money run out, all of us lose our money. So of course we want to think about the journey of the founders and thinking about how the quality and the ability for the founders to adapt.
Okay, Dustin, I saw that you unmuted yourself. Is there something you want to add?
No, I was just unmuted most of the time.
Okay, I have another question now. The Q&A is on within the Zoom itself. There's a question from a Trevor to ask about your advice. I think it's again on Wei Shen and Michael. What would your advice be in dealing with situations when investors walk away from their signed term sheets before COVID? So I actually know of one startup that actually decided to wrap up the business because the term sheet, even though it was signed, the investor decided not to honor it. What would your advice be?
I don't know if I have any good advice other than the fact that you need to recalibrate your trust in this particular VC. Then, I mean, it could be a legitimate reason. It could be, because of COVID, the demand for that particular product or that particular business just kind of went to zero for the next foreseeable 1 year, and the VC, in the interest of protecting their own investors, could walk away, and I think that could be a legitimate reason. In any case, term sheet, we know, is a gentleman's agreement. It's not legally binding, and in the event of such a drastic situation, it's not in good form, I suppose, but I can see why the VC thinks that way. Now, that said, I think what is not so good, and I've seen this happen in a few cases, in fact, one to our own portfolio company, what happened was there was predatory instincts. So there were, as opposed to, I still want to invest, but now my terms have changed. So it's not, it's not walking away completely, but now my terms are a little bit more onerous. And then there was some back and forth and entanglement, I guess, in terms of wanting to renegotiate. So we did that, helping our portfolio company to renegotiate terms to come to a better conclusion. I'm not sure whether there's anything that you can do, because legally speaking, there's nothing. It's just not binding. I would say give yourself optionality, speak to more people, start your process earlier on. First of all, if you think that you need 2 months to raise, start 6 months in advance, and then hope for it to close in 2 months, and talk to as many people as possible.
Michael?
Yeah, I would say very much.
And investors.
Pardon?
Being both angels and investors, you were in different shoes. How would you advise?
Look, I would answer a very similar way. When you're raising money from an investor, it's very much about, we're investing into an entrepreneur. It's very much based around the relationship, and it's about keeping a good relationship. Pardon my language, but screwing over the entrepreneur in the short term is going to bugger me down it's going to cause me issues down the line, because it's going to damage the relationship. And for a successful company, you need everybody working on the same hymn sheet. You don't want to feel that, if the entrepreneur feels the investors have taken advantage of them in a difficult situation, it's not going to build that trust and support that you need to be successful in the long term. So, as was just said, is that if there is a fundamental change in the business, then it's up to a point it's okay to change sometimes the valuation or the terms of the business, and as long as it's not waited until the last minute. So one of our companies, literally the last minute, literally 2 days before the deal was due to close, the investors came back and said, we want to reduce the valuation by 30%. And it's a take it or leave it type of thing. So we decided that we could leave it, because we would fund it ourselves and do a bridge round ourselves. I've definitely seen some predatory. So we have seen some term sheets out there that have not necessarily changed, but been very aggressive from the VCs. So they've asked for kind of like 3 times liquidation preferences and everything else like that. Again, we just tell them, no, it's better not to have the money than to have the wrong money. So if from the entrepreneur's point of view, if you think that the investors are being dishonorable, it's better not to take the money than to take the money. Because for investors, we go very much on our gut reaction. You've got to do the same thing, and you've got to think of it as a relationship. So sometimes it makes your life more difficult turning money down, but it's better for you in the long term to make that decision than take the wrong money.
I can't imagine a 3x preference, the liquidity preference. You might as well just hang X over your door. And
it was participating. It was participating liquidation preference.
I thought I was the only one who saw a 3 above 3x, but it seems like you have the same experience. But okay.
Yeah, and this was at a pre-Series A round. I mean,
oh my God.
It was quite shocking, to be honest. But you just got to be aware of what is acceptable. So it wasn't started off, but yeah, I think that it was surprising.
I think so. This question actually was asked by a different person, came out in the previous chat we had with the 5 VCs, right? And at the time, really the advice was really move on and know what this VC is about. If you want, you could share with your close circle to warn everybody else about this. But I think for the VCs, if they do it nicely, like what Wei Shen say, they advise accordingly, explain properly what's going on with them, then it's something that's acceptable, then so be it, because situations change. But if they are predatory, I think it's something that as a founder, you will want to cautiously warn your circle of friends so that you prevent people from falling into the same trap. Yeah.
But can I say,
yeah.
But this should be any time, even pre-COVID. I would always say that even before you take a term sheet, and this is from the entrepreneurs, even before you accept a term sheet from a VC, you should reach out. Don't reach out to the founders that I tell you to reach out to. Reach out. It's easy to find out who my founders are. And then you've got to ask. You've got to ask the right question. You've got to ask, when things go badly, how do the VCs react? That's probably the most important question for you to ask, because if everything's gone well, everybody's like, oh yeah, no, they're wonderful. If you just ask a generalized question, how do you find the VC, your VC investors? Oh, they're fantastic. What you've got to find is, when things go wrong, do they roll up their sleeves? Do they try and take advantage? And, off the record, founders are very honest when they're talking to each other. And as Shannon said, they will, if somebody is bad or, whatever, they will tell you honestly. So you should always be doing that, because there's certain people out there that do have a certain reputation. There's other ones that have a better reputation. So you just got to be aware of it. But this should be all the time. You should be doing that, because the VCs have a track record. That's all,
So the next question actually I also targeted at the investors. Robin is asking, are the risk appetites of the investors smaller now or more cautious? And does it mean that the investors prefer to have more investors join in for the round as well? And if the ticket sizes are smaller? I think Wei Shen actually is still based on your fund's mandate, right? I would think.
I think so, yeah. I can't imagine the fund will suddenly fundamentally change its strategy because of COVID, because of COVID. But what I would say is this: I think, sorry, let me just recap and read the question properly before I answer.
Q&A is like,
yeah,
very long.
I think
from Thomas as well.
Yeah, I think at the start, when it was around the March or late February period, I think it was quite clear that there was some uncertainty, and it was also clear that we don't know when the uncertainty will end. Some people think it's a few months, some people think it's a few years. So I think there was a more or less a wait and see approach at that point in time. But I think now most investors have normalized and have we are all living with the fact that this is going to be the case going forward. This is going to be it. So all these appetites are returning. I don't think any investors is holding on to their wallets now. Another, I guess, semi-pro tip is that most VCs have a fund life, right? I can hold on to my money for 3 months. I cannot hold on to it for 3 years. Otherwise, there's no way I can meet my obligations as a fund. And this also goes back to, I think, the previous question, right? If somebody walks away from your pulls out the term sheet, what I would say is the following: if you can, and this is, I might be letting on more than I should, but it's a bit of waiting game on both sides, right? The investors need to invest. It's not that we can just hold on to money forever. So if you are able to understand a little bit the dynamics, then you can, come up with a better fundraising strategy. So yeah, I guess that's my 2 cents.
So actually, Wei Shen highlighted the very, very strong insights on fundraising. Actually, a lot of founders, I realize that when you're fundraising, right, you don't do the due diligence understanding of how VCs work. It's the same thing as you trying to profile your customers. You need to understand how to trigger them to buy your product. When you're fundraising, you really need to understand how the VC industry work. So, I mean, short of telling you where to read up, actually, it's really research you need to do to understand how the industry work and how they deploy their funds for you to do very proper fundraising activities. There's a Mr. Thomas Tam who has a really long question. He feels that actually basically investor mindset didn't change much, but perhaps how founders are able to show that business in fact is relevant to the market, perhaps even more so during the pandemic, will help them to become more attractive to investors. The question is, during this period, will be making a difference to investor if a startup is able to showcase our capability to start, build, and still create a difference during this period. Like on top of my usual pitch content, I have extra emphasis on this. Do you mean that you can showcase your caliber and additional things that you do? I would think that the answer should be yes, right? Okay. We have one question on top from Dan Luo. Is it true that investors are more interested in tech businesses as compared to traditional businesses such as brand supplier?
Let me think how to answer this question. I guess you are.
I'll say yes.
I guess so, especially for Michael, right? Because you're in deep tech, so obviously yes for you.
It's yes for you. I think, again, it goes back to what Xiaoning was saying, is understand that what the VC mindset is. And Xiaoning, I can send you a really, really good deck, which really simplifies the VC model and how we make money. So it's really good for entrepreneurs to look at, because they understand what motivates us. I'll send that to you later.
Put it up on the resource center.
Yeah, it's not one I've done. I've stolen it from somebody else, but it's a really, really good one.
Okay.
Look, we're looking for high growth businesses. You know, we're VCs of businesses ourselves. We've raised money from our investors and we promised them gigantic returns, and that's how we're going to make money. The reason that we do like tech, it's not necessarily tech, it's like high growth. We're looking for companies that are potentially going to be home runs rather than kind of infield hits. Now, quite often we end up with infield hits, but we've got to at least start with the belief that they can give us gigantic returns if everything goes according to plan. So I've turned down a lot of companies which I think are good companies, they're going to make money, but I think best case scenario, they're going to make 2-3 times a return for me, which as a seed investor is not going to then pay for all of the crap that I end up investing in. So I need the big returns to make money, but also to cover all the companies that don't succeed, because, you know, I'm investing in fumes and you know, hope more than data and reality. It's slightly different for later stage investors. They've got most of their investing companies will have kind of like revenue and such like. So for me, yeah, the reason tech I'm looking for, it's not so much tech, it's high growth I'm looking for.
Yes, so this is what we usually will tell our members, that what we are trying to find is highly scalable businesses that can scale. And so like actually both Dustin and Peg In and Caleb actually recently did their syndication with AngelCentral. They are technology business, consumer facing technology business. So usually it's very different from what Michael is doing, right? But the thing is, in this space, like what Dustin was highlighting a lot, is that right now during the COVID period, as a founder, his storytelling has changed. He has employed COVID to his benefit, and that's why he's not affected in terms of sales. In fact, the sales actually went up a couple of times. So it's really what the founder, it's like what Michael said, is we're investing in the founder, we're investing in the story, we're investing in people who know how to steer the ship during whatever timing it is. And ideally, the investment will get us 10, 20, 30 X's. We can't do a 2 to 3 X's for early stage investor because mathematics just doesn't work out. So again, for the founders of fundraising, you really should read up on how the VC industry work and how the VCs evaluate and do their projections. I'm just running through the questions.
Xiaoning,
yes,
can I suggest maybe we ask PS Love to make a comment and Justin to make a comment as well, because technically they are on the borderline of tech companies, but consumer facing companies, right?
Yeah,
they are high growth, which
high
is
growth,
why we invested in them. So maybe they make a comment versus high growth versus tech.
Okay, yes, please.
Just I can start first. Yeah. So I think, yeah. Then the question from Dan, I think because investors, there are so many different, in a way, categories, right? So, but definitely they need growth, right? So yeah, definitely growth is like the key metric. Even if it's in a traditional sector, or using traditional channels, if there is very high growth and can be very scalable, it can still be very attractive. That said, if the business is not in kind of like that high growth segment, or you don't see a way to do it, then I think maybe like alternative investments, whether is it debt or yeah, I mean, you can also look at like single family offices, multi-family offices, where they might have lower thresholds on the return. It could be something to explore as well. Yeah. In terms, yeah. So Peg, you want to go? Yeah, you can continue.
Yeah, just to chime in a little bit. So I think it's also for a consumer business like ours, I think it's also on us founders to also share how we see the business in terms of how we think it can really go for scalability and high growth. So I think something that may not be very familiar. I mean, like if investors are looking at a tech space specifically, our kind of business model may not be very familiar to them. I think it's on us to really like share, why we think that what we do can really grow fast and scale fast. Yeah.
Okay. In the interest of time, we are 4:59 now. I just want to bring up the last question. I think it's quite an interesting question, but I think Michael will scream. As a founder, I personally find fundraising a very tiring process. Are there companies out there that we can outsource this to?
Yes, there are. I guess they are called investment bankers and other capital advisors. But I would highly recommend not to, especially at the early stage. I think at the early stage, investors are investing behind founders. Not so much the product, not so much the traction, not so much your cash flow, because cash flow is all negative. So we are investing behind founders. And so who else better than to tell the story yourself? Your banker can't do it for you. Other people can't do it as well as you can. So I would highly recommend that you go through the process yourself. It helps as well, because even at later on stages, right? And I know I'm stretching a little bit further ahead. When you're thinking about Series C, Series D, exits, right? You need to be at the forefront. And to have that experience at the start will be useful for those experiences that comes later on.
Michael?
I 100% agree. The only caveat I would say is when you get to Series B, quite often, if you're a Singapore or Southeast Asian-based company, when you go to Series B, quite often you are looking at global funds. So actually getting somebody to help you outsource a little bit to do the connections and introductions to those global VCs or global, corporate investors, or if it's looked to do an acquisition, I think then use professionals at that stage. But at the seed and Series A, it's got to be you. I actually, if somebody comes to me, especially at the seed stage, and they've outsourced like their financials or their debt or whatever, I actually say no, because they're wasting their money. I mean, if they don't have confidence to do it themselves, I'm not looking for perfection. I know at the startup that, founders, it's the first time they're fundraising and, they're pretty inexperienced, but I want to see what I'm working with. I don't want to hear somebody else's idea of what they think the company should be doing, because that's what they think I want to hear. So I want to have the data and the knowledge, because then I know what I'm working with. It's all about uncovering the strengths and weaknesses of founders, not because it makes my investment decision, because I then know how much support I'm going to have to give to them and what support I give to the founders post-investment.
Yeah. Okay, in the interest of time, but I think the last question from Deepak is actually quite relevant for a lot of founders. Do you mind we extend just 5 minutes of your time? Okay, so Deepak is asking, fundraising is a very time-consuming affair. How do you still manage to focus on running the company or engaging your customers? I think it's a struggle that all founders go through. And Nimanta will remember my nagging.
Yeah, definitely. So I'll just jump in maybe after that. The other panelists can share their experience as well. So this is, I guess, the best part of having two co-founders. So in our case, I completely switched to fundraising. So I think I was spending 80% of my time on fundraising matters, having investor calls, sending decks, having calls and help supporting DD and all of that. And the remaining 20% was on the sales stuff that I oversee. So that was my entire role during this whole process. So it's definitely time consuming. It took more time for us as well, though it was like a pre-series A round. We were trying to get new investors on board. So we tried quite a lot, although we had the commitments coming in from the existing investors, because we thought it would be nice to have new connections, like because each investor, like I think it was Michael who pointed out, like it should be smart money. Like each investor should bring something other than money. So we're trying to look out for strategic support, although we were like rushing for time. But yeah, predominantly I was spending a lot of time doing that, and my co-founder was running the business, the product, and yeah, helping with that.
Yeah, in my case, I had to split my time, half on fundraising and half on the business itself. I didn't have to do a lot of those cold emails, cold pitches, because we had really good support, both from Wavemaker and also Endeavor. I'm not sure if you're familiar with Endeavor, but it's a nonprofit organization. Yeah, so they were able to make the introductions, and all I had to do was to follow up, pitch to the investor, work with them on the due diligence. Yeah, so that helped a lot.
I think maybe you can sleep less. Just joking. I mean, if you have a co-founder, that helps a lot. If not, you might have to delegate. So basically, either you are in fundraising mode or not. So once you start, just chung as fast as possible. And then remind yourself, as with all fundraising rounds, you can have 100 no's, but you only need one yes, and it's done, right? And usually when you have one yes, you have more yeses that follow. I think we did reach out to probably close to 100. Yeah, try to have fun while fundraising. Focus on the learning, the people you get to connect with, rather than individual outcomes. And a lot of the times, the people you speak with, after they get to know you, maybe they can come in the following round.
Yeah,
Okay.
so I think just to maybe just to add on to that as well, I think building that relationship is important, because they may not invest in you now, but then you never know how they can come into the picture in the future. So I think instead of just seeing it as like, okay, I need the money, the fundraising, treat it as, like really relationship building and making that connection. So I think that mentally it helps a lot. Yeah.
Okay. So fundraising really is a very tiring process, and nonetheless, the COVID situation, and actually one of the questions was I didn't highlight on that, is actually a lot of founders they actually feel that it's may not be very reasonable for the investors to focus on revenue during the fundraise during the COVID period. But then the thing is, businesses are meant to be business. So VCs are also doing a business. So if you are asking VCs to ignore a key feature or key indicator of how to evaluate a business during the COVID period, it's actually not very fair, right? So it's I think it's really how the founders have to evolve yourself like a Pokemon. You really just have to evolve yourself. There's no fixed way of doing things, but you need to know the map you are playing on and need to know how to play with the environment that you have. And you cannot expect the VCs to forego their primary objective for running the business as well, right? Okay, with that, I would like to thank everybody for taking the additional 6 minutes with us. And please stay safe. I know it's phase 2. I know we can go out for dinner, we can go out for all these things, but please still stay safe. We don't want to be like one of the other Asian countries that actually had to go into second lockdown. I think that will be very, very stressful, and it will not be very, I don't want to be working from home with my 4 kids having homeschool again. Okay, so let's all stay safe and let's all stay at home. Okay, good night, everyone.
All right, thanks everyone.
Thanks a lot. Bye.
Bye.